A one-line warning from the Federal Reserve Chair just knocked the British pound to a one-week low. On Friday the 28th of August, 2026, pound sterling to US dollar dropped to 1.3538, down 0.4% on the day. In his first Jackson Hole speech, Kevin Warsh said inflation is not meaningfully slowing and the Fed still has work to do. That revived bets on a September hike. Prime Terminal shows the odds jumped from 43% before his remarks to 50% after. Higher US rates make the dollar more attractive, pulling money away from sterling. This did not come from nowhere. On Thursday, the dollar hit an 8-day high after July PCE inflation beat forecasts. Headline PCE rose 3.7% year-on-year, against 3.6% expected, while monthly core PCE rose 0.2%, double the forecast. Because PCE is the Fed's preferred inflation gauge, that kept tightening bets alive. Warsh reinforced it, saying policymakers should not pre-commit to a set path, calling for a discipline, not to a decision. Meanwhile, sterling lacked domestic catalysts. Bank of England rate expectations softened, and Scotiabank said that eroded the yield spread support for the pound. Soft CBI business sentiment only added to the weakness. For real money, this matters. The US dollar index climbed over 1/3% to 99.49, and the 10-year Treasury yield rose to 4.686%. That makes US assets harder to ignore. British importers now pay more for dollar-priced goods, and holidaymakers get fewer dollars per pound. Traders also saw pound sterling to US dollar break below the 1.36 support level. Samuel Toombs of Pantheon Macroeconomics noted investors now price 53 basis points of Fed tightening over 12 months, up from 45 before the speech. That is a rapid repricing and it leaves sterling exposed. The next move depends on two tests. First, any follow-up Fed comments could cement or cool the 50% hike probability. Second, UK data has to hold up enough for the Bank of England to avoid falling behind. If UK yields slip while US yields rise, the spread narrows further, and pound sterling to US dollar may retest the lower end of this week's range. A recovery would need a push back above 1.3664, the recent 7-day high. The base case is cautious. Sterling has not collapsed, but it has lost its near-term catalyst. Unless UK data surprises to the upside, dollar strength should keep the pound under pressure. Today's move is a reminder that currencies respond to relative interest rates, not just headlines. Warsh did not announce a hike, but he shifted the odds. The pound fell because the market believes the Federal Reserve is more likely to tighten next month, while the Bank of England is not. If US inflation stays sticky, the dollar's edge grows. If UK data improves or Fed language softens, sterling could recover quickly. For now, Friday the 28th of August, 2026 belongs to the dollar, and the pound is paying the price. Watch the data, watch the odds, and never fight the central bank.